Hello and thank you for joining me today. My name is Calhoun and today I'm going to be talking to you about life insurance. Now, a lot of people ask me, Devon, why life insurance? And I ask them, why not life insurance? Because on the lowest level, life insurance is income replacement, right? So if there's anybody that depends on you for your income, you should have life insurance, right? If you pass away or your spouse passes away, the last thing you want is your kids to worry about life changes because they lost a parent, and losing a parent is definitely going to be enough. So the amount of life insurance that you have and the type of life insurance that you have is unique to each person. So I'm going to explain these different types. The first one is going to be group life insurance. Now, group term is what you get through your job. Now, this type of insurance is very inexpensive, and it's inexpensive because you have a large amount of people that's paying to get this life insurance all at once. So that drives the price down. Another thing that drives the price down is 1% of this life insurance pays out. So most people don't die at their job. So that's why it's so inexpensive, right? The negatives about having this life insurance solely is the company owns this life insurance. So if they decide to not pay for it, you lose that life insurance. If you change jobs, you lose that life insurance. If you retire, you lose that life insurance. So it's always good to have something that you own independently of group term. So the next life insurance that I'm going to talk about is term insurance. Now, term is relatively inexpensive as well. You get a large amount of death benefit for a small price. And one of the main reasons is because 2% of term insurance pays out. Term insurance, it serves a certain purpose for a certain amount of time. It's just like renting a house. Like when you rent a house, you have a year contract or a year lease, and once that year is up, the landlord doesn't owe you any money. You don't owe the landlord any money. You sever ties, and that's that. Now, you can go on to another lease, or you can buy a house at that point, but no one owes anybody anything, right? So whole life, on the other hand, is just like owning your home, right? And when you own a home, the more you make payments, the more cash value or equity you grow inside of that. Same way with whole life. It grows the exact same way, but except when you pour this money out of your whole life, it comes out completely tax-free. Now, if you want the perfect blend of these two, you can look at a UL. The UL is universal life, and what universal life provides is whole life at term pricing. So what's that? The next thing that we look at is VUL. VUL is variable universal life, and some people call it the rich man's Roth. And for this reason, a VUL, with a VUL, you're able to take advantage of the stock market and the gains of the stock market, all while having it tied to your life insurance policy. So when you pour this money out, this money's going to come out tax-free, just like the whole life. So this is definitely a great tool to have. It's just like having a 401k that you put $500 in, and if you pass away, you get a much, much larger death benefit. My name is Devon Calhoun, MBA and financial services professional. Thanks for listening.